Did you know that the price of puppies has gone up more than 200% in the past 2 years? Those little bundles of joy that we love to have in our lives has gone up dramatically. And do you know why puppies have gone up in price? I can tell you why. It's because there are only a certain number of puppies available to buy in Australia, yet everyone wants to own one. So we have the supply of puppies being held constant. There are no more puppies getting created this year as there were last year or the year before. Maybe a few more, but let's just say it's even. But on this side, we've got more people wanting to buy puppies. So we have more people wanting to buy and the same amount of supply. In economic theory, what that means is the price of puppies is going up. This is what we call inflation. And inflation is the increase of the prices of things around you, like fuel, bread and milk, all of the things that you buy to keep your house or your work or yourself in line. Inflation, when it increases, typically carries with it the fear of rising interest rates. So as inflation increases, so does the expectations of interest rates increasing. Because under academic theory, we're taught that increasing the interest rate will bring the inflation back down. So what does that have to do with anything? As interest rates increase, what we typically find is that the price of shares, bonds, property, cryptocurrencies, and many other things actually falls. And that's because more people would probably just be safe putting their money in the bank and earning a good amount of interest. So that's why things are falling. The uncertainty of rising inflation and increasing interest rates has spooked a lot of investors. Of course, there are many other things to worry about. I want you to imagine something. Imagine that instead of the supply of puppies being held constant and the demand of people wanting to buy puppies going up, imagine that next year there are more puppies. And next year there's not as many people buying puppies because they want to go on a European holiday because they've been stuck in COVID for the last 2 years or 3 years or whatever it is. Eventually, the price of puppies will stabilize, and the fear of increasing prices will no longer be there, and interest rates won't need to be increased so we can control the price of puppies. This is happening across our economy and across the world right now. We're seeing the prices of construction goods like steel and lumber or wood, timber, going up through the roof. We're seeing the price of fuel going up because of geopolitical risks. All of these things are increasing, which increases fears of inflation. But here's the thing, the long-term investing principles have not changed. We've seen the prices of many investments come down, and the prices of the investments that are considered the most risky, so things like cryptocurrency, unprofitable technology companies, and really speculative investments, have come down. And that's normal. That's what you expect to see in this type of environment. All of a sudden, we've gone from people wanting to spend money and kind of spend frivolously because they had heaps of savings. And now we're seeing people being a bit more fearful of their investment portfolio and pulling back. That means prices come down. All of this is just a reminder of some really important stock market facts. The first thing is that on average, the stock market corrects, meaning that it falls 10% at least once every 357 days, or once a year. So this is based on stock market history from Deutsche Bank. And what they found was that on average, once every 357 days, you can expect a 10% fall in your investment portfolio. The second thing comes from Tony Robbins' book, Unshakable, and I'll quote that or paraphrase that kind of section in there where he said that only 20% of stock market corrections turned into market crashes. So what that means is we can expect a fall of 10% once a year, which is going to hurt, and then only 1 in every 5 of those is going to turn into a severe market pullback. And by that I mean something really big and meaningful. But you know what? Here's another stock market fact. The stock markets of Australia, the United States, heck, even Europe, have been around for hundreds of years. In fact, the stock markets of Australia and the United States have performed in double digits, meaning that they've returned over 10%, including dividends and growth, over the last 30 years. And in that time, we've seen wars. We've actually seen a couple of them. We've seen things like inflation being over 10 or 15%. We've seen interest rates over 10%. We've seen the GFC, the dot-com crash. We've also seen presidents that do things that are a little bit unusual. We've had prime ministers that probably make decisions for our country that maybe aren't in our best interests. we've seen countless things to worry about. And you know what's happened? The stock market has still performed well. Now, if you got caught up in any one of those little things at the time and you thought, I'm going to sell out now, you would have missed the growth that followed. Just remember that businesses, as in companies that you can buy on the stock market, they create value for customers. The reason that they make profits is because they solve a problem for their customers. And if they don't create value, if they don't solve problems, they won't be in business anymore. And that's why I believe the stock market is the best place to invest the majority of money for the very long term. Now, I'm not talking about share prices going up and down. That's complete randomness. From one year to the next, random things happen. The uncertainty is always going to be with us. There's always something to worry about. That's why the news tabloids, the financial tabloids, try to give you certainty. They say the stock market is crashing, here's what you should do. They say the stock market is expected to rise 10%, says expert. And they give you all of these kind of false hopes and these false certainties, but none of them are real, at least not in the short term. Number one, does your portfolio represent the best version of the future? Motley Fool co-founder David Gardner has this fantastic saying that his portfolio reflects his best version of the future. Now, he knows that the stock market is risky. He knows that some investments won't work out. But he knows that companies and people that power companies are what solve problems. So over the long term, the shareholders who own those companies will benefit. Ask yourself, does your company, does your portfolio represent your best version of the future? And I'm talking 10 or 20 years from now, not what's going to happen in the next year. I want you to go through your portfolio and follow these 5 steps. Number 1, does the business offer something, a product or a service, that is mission critical, a really important thing? So like energy companies. Energy companies provide surety to their shareholders because everyone still needs to pay the electricity bill. That's just one example. I don't invest in energy companies, but you might, and you might find that that's a really safe industry to be in. Number 2, does the company have a visionary management team? A management team that kind of does what they say. Do they still take this opportunity to grow? Number 3, does your company have a strong balance sheet? You can find out if a company has a strong balance sheet by looking at their financial statements in their annual report and seeing how much cash is on the balance sheet versus how much debt. The debt is known as short-term debt or long-term debt or even interest-bearing liabilities. Number 4, is the company growing? Now, this is going to require you to kind of have a bit of an imagination and to set some forecasts. Does this company have a reliable history of growth, and is it expected to grow in the future? I think that's a really sensible thing to ask yourself. Is this company still going to grow even if we're in inflation? Number 5, does the company have a strong brand? Does its customers and do the people that know it actually value it? Do they spend money continuously? Do they see this brand as an industry leader? If it's not an industry leader, if it's not a company that's making lots and lots of revenue or sales, maybe now is the time to take some of those chips off the table and put that money into something else. Finally, if you're a retiree and you're thinking, Owen, I don't have any money to invest right now. I'm actually relying on my money. Now is the time that you can think about rebalancing. In a market crash, having a plan gives you more confidence. So hopefully you've already set your plan and you know that your diversified portfolio is actually doing what it's supposed to do. Yes, the stock side of your portfolio might be down, but maybe the bond side or the cash is still there. Now is the time to rebalance and do that over time. Don't rush into it, but have a plan and stick to it. I'm an accumulator, meaning that I'm investing for the long term because I'm getting a salary and I can continually invest in ETFs or into shares that I think hold long-term value. Remember, the stock market is the source of value creation for capitalism. It's where companies and people that power companies solve problems. It's not about trying to predict what's going to happen in the next month or two or the next year or two. It's about imagining a future where companies are more profitable, solving more problems with new products and services that delight customers. Focus on the companies that represent your best version of the future. Now, more than ever, that's important. I'm Owen Rask. You can find more checklists and more helpful tools just like this on the Rask Australia website, on Rask Education, or by heading to our Rask Media News website. Thanks for watching this video, and remember, stay calm, onwards and upwards.